Welcome back, everyone. Today I'm going to be reacting to Graham Stephan's video, How to Invest in 2024, The Best Way to Get Rich. Let's get into it. Hello again, and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner, and today I'm going to be reacting to Graham Stephan's video here, How to Invest in 2024, The Best Way to Get Rich. Is it really the best way to get rich? I don't really know. Let's get into it. See what he has to say.
Because despite what you might think, being able to get rich and stash away a ton of money is a lot simpler than you'd expect. And if you could just learn the basics, it becomes insanely easy to be able to turn 100 into 1,000, into 10,000, into 100,000, into eventually $1 million, especially when one study found that 80% of millionaires come from families at or below middle income level. So as a bit of a solution to this,
So I don't know about you, but I think it might take a little while longer than he's suggesting to turn $100 into $1 million. I don't know. That seems a little suspect. Let's keep going.
here's exactly what you need to know, the step-by-step blueprint that every wealthy person follows, how and where you could get the highest risk-adjusted returns, and then finally, where I am putting my own money over the next 10 to 20 years, since I'd like to think I put my money where my mouth is. I think I'm doing this right. Although before we start, as usual, if you appreciate videos like this...
Okay. So he's going to give us a step-by-step blueprint that every wealthy person follows. That's what he's promising. Now, it's kind of funny because I have a 5-step blueprint in my book, which is an Amazon bestseller. It's called Between the Lies, How to Reclaim Your Future from the Banks and Wall Street. Find a link to it below. It's in print, digital, and audiobook, narrated by me. But I have a blueprint, which is a very, very open-ended, generalized set of rules, and they should be followed in order, but it's not, well, I don't know what his steps are. So I don't know. I don't know. Let's see. Before I say too much, let's see what he has to say.
All I ask for in return is that you hit the like button and subscribe. Doing that just helps out the channel tremendously, and as a thank you for doing that, I'll do my best to respond to as many of your comments as possible. So thanks so much, and also big thank you to Surfshark VPN for sponsoring today's video, but more on that later. Alright, so in terms of where to start, let's get back to the basics. No matter who you are, what you do, or how much you have invested, everybody I know optimizes for something they're always going to keep, and that would be cash. When it comes to this, the reality is most people have no idea how much money they spend or where they spend it on. All they know is that they have a certain amount of money in their bank account or a certain limit on a credit card, and that's what they could afford. Then when their account gets too low, they cut back on purchases until the next paycheck comes in, and then the cycle repeats itself. But this is not how wealthy people manage their money. So if you would like to optimize for cash, which arguably is the entire foundation of being able to build a lot of wealth, start by tracking your expenses over the next 60 days using a software like Rocket Money, You Need a Budget, Every Dollar, Monarch Money, or even your own Excel spreadsheet, and then log every penny that goes into and out of your account. From there, you could determine if you're spending money on things that don't matter, if you're making short-term impulse purchases, if you're overspending on categories that you could negotiate or get for way cheaper, and then hopefully you could cut back and reduce some of those expenses. From my experience, just by doing this one thing, you should be able to save an extra 10 to 15%, because just like a diet, once you become aware of the details, you could begin optimizing for everything. Without exaggeration, there has never been a better time than now in the last...
Okay, before he gets into whatever this next thing is, yeah, I mean, you should budget. You should be aware of where your money is going. You should be in open communication with your partner about where your money is going. You should be on the same page, going for the same goals, that kind of thing. Tracking expenses is very useful, especially when it comes time for taxes if you are self-employed like I am. But, okay, I mean, we're off to a good start, right? That's good. That's a good thing to do. I disagree with most modern budgeting methods. I don't like those budgeting softwares that he put on screen, but that's maybe a separate video. Okay. I don't think, especially if you have uneven income like I do, that that's necessarily the best model, the models that are out there. I don't think they're really the best way to plan your spending, but it's better than nothing. Something I don't appreciate here is that it's like he's talking down to people like, well, you must be overspending 10 to 15% easily, and you're obviously spending money on things. You're just running up your credit card until you run out of money, and then you just wait for your next paycheck. I don't know. I mean, I'm sure some people are doing that, but that's a weird assumption to make. It just feels like he's talking down to his audience a little bit there.
Last 20 years to make money on your money, since high yield savings accounts are at worst paying you at least 4%, and with a little finessing, you could even earn 5% or more. Like Ally Bank is currently paying you 4.2%, and they're a completely online bank that does nearly everything you'd ever want them to do for completely free. Or Wealthfront is currently offering 5% in your money, and Robinhood Gold members could get 5% as well. Alternatively, if you have some money that you don't mind sitting on the sidelines for a little longer, you could also look into Treasury money market funds, which are currently paying above 5%, like VUX6 from Vanguard or SWIFT6 from Schwab. Personally, I've taken the approach of keeping about 20% of my overall portfolio in a mixture of high-yield savings accounts, money market funds, and treasuries, where I'm currently getting paid above 5.2%. To me, this is money that I'm saving for the near future, and it's also my sleep-at-night fund, knowing that no matter what happens to my income, the economy, or my investments, I have this to fall back on, and it's earning a pretty decent return in the process.
Okay, so it looks like I paused in the right place. So, I don't have any problem with having some cash. That's good. Having some like physical cash is good. Having some gold and silver is good. Having some money in a savings account, checking account, those kind of things, that's all good, right? You need to have money to operate, particularly if you're running a business. You need to have some cash. It's called cash flow. You got to manage your cash on hand. And so that's all important. However, high yield savings accounts, yeah, I mean, this is an anomaly, this period of time that we're in. Savings accounts are paying pathetically low interest rates just a couple of years ago. And so the argument that 20% of your money should just be in high yield savings, I don't know that I agree with that. He did mention treasury bonds and those sorts of things as well. Okay, fine. Those are all variable interest rate type vehicles. It's not guaranteed that it's going to continue to do that. Um, High yield savings accounts, it's just kind of a weird thing. Everyone seems to be fixated on them because the rates are pretty high and it's perceived to be a zero risk tool. However, banks, banks in the United States don't have your money. Okay. You go deposit your money and it's gone, man. They are going to create tons and tons and tons of new money based on the fact that you made a deposit, and they're going to lend it out to other people. They have an extremely small percentage of what they say that they have actually physically there at any given time. It's called fractional reserve banking, if you're not familiar. And what does that mean? Well, if you go deposit $10,000 in the bank, they're going to create $90,000 approximately. It's actually probably even more than that right now. 90,000 or more new dollars that didn't exist before out of thin air. They're just going to magic that into existence and loan it to other people at interest. And so I don't know. I don't like to have a whole lot of money in the bank. Y'all heard me say at the beginning of this video, I'm an infinite banking concept practitioner. I've been doing infinite banking as a client for longer than I have been selling life insurance. So let's get that objection right out of the way. I got into this because of how much it was changing my life. I didn't start doing it because I sell it. Okay. But that's always going up. Okay. And it's not subject to swings in interest rates from the Federal Reserve. It's not subject to what the board of the Federal Reserve says they're going to do to interest rates. Here's a fun story. I have a very good friend that we've known for a long time, and he went in to a bank to deposit some money. This is a few months ago now. And he was given a flyer about their consumer and high yield savings accounts, advertising their excellent rates of return and encouraging him to sign up for one. He just took the flyer home. Okay. He was back into that same bank a couple of weeks later, and he said, "Hey, I'm thinking about that high yield savings account." The clerk said, "Oh, we don't have high yield savings accounts." And he said, "What are you talking about? I got a flyer from this branch 2 weeks ago." And they just sort of were flustered and said, we just don't have consumer high yield savings. That's not something we offer. Not that we stopped offering it. They were acting like it never existed. Okay. It's this gaslighting kind of weird behavior. It's like, oh yeah, we don't have that product. We don't do that. That's not a thing. But it was, And so he didn't argue with him for too long or anything, but that's really interesting. And so what was going on is that it was about to be the Federal Open Market Committee, the FOMC meeting, where they decided or announced whether or not the Federal Reserve was going to raise or lower interest rates. Now, the Fed does not set interest rates for the whole economy, but a lot of things are based upon, in some way, what the Fed is paying. And so the bank that my friend was in was afraid that interest rates were going to be cut. They weren't at that time, although I'm sure they will be at some point in the future. They weren't cut. And so now that same bank is offering high yield savings accounts again. It's pretty weird, that they would just act like that didn't exist. Anyway, if you think of where your money's at, and you think, okay, well, banks used to be paying 1%, half of 1%, 1/10 of 1% on a savings account. And then everyone was just obsessing over high yield savings, money market accounts, things like that. And now they're over 5%. Well, okay, you have a couple of years of 1% or 0.5%, and then you have 2 years, 3 years, 4 years of 5%. Great. And then it goes back down to 1%. What's your average if you keep the money in there? What's your actual compound growth rate, or CAGR, compound annual growth rate, number I really like to use? It's not going to be 5.2% or whatever. It's going to be kind of low, particularly if you look at it over a long period of time. So immediate short-term stuff, great, okay, but I don't like to keep that in the bank. We keep up to a certain threshold in checking and savings accounts, and then everything else goes into life insurance policies, because life insurance policies are 100% reserve. If I ask for the money, they give it to me. If I go to the bank and ask for my money, they can say, well, you got to wait a couple of weeks. Well, we don't actually have it. Well, a lot of other people ask for their money today. We're actually closing because we don't have the money. Banks have, this is not a hard and fast number because I don't know the exact figure right now, but it's around 3% of what they say that they have is actually there. That's pretty low. So if all the people show up at once and say, hey, where's my money? They can't give it to you. It doesn't exist. Okay, let's keep going.
Now, next second, once you built up a small cash position, now is the best time to begin paying down high interest rate debt. Look, the fact is, debt is starting to become a massive problem. And if you don't believe me, take a look at the numbers. The average American now owes more than $22,000. Credit cards, car loans, and personal loans make up almost all of this. And at today's interest rates, if you don't make an active effort to pay it down, you could easily be losing out on thousands or tens of thousands of dollars a year. So here's how I approach debt. If the interest rate on my debt is higher than what I'm able to safely generate from my investments, then I pay off the debt no matter what. And if the interest rate is lower, then I pay it off as slowly as possible and I invest the difference instead. Or basically, all you have to do is take a look at the debt you have and ask yourself this question: can I get a risk-free, guaranteed higher return somewhere else? If the answer to that is no, then pay off the debt. Although if you want to pay the debt down as fast as possible, there's two strategies to go about doing this. The first is called the avalanche method, and mathematically, this is the perfect way to pay down debt. This works by paying down the highest interest rate debt first that's costing you the most money, and then once that's fully paid off, you'll pay down the next highest interest rate, and the next, until eventually it's all paid off. On the other hand, the second method to pay down debt takes on a more psychological approach, and that's what's called the snowball method. This works by paying down the smallest balance first, regardless of the interest rate, and then paying off the next smallest balance, and so on. The reason this works so well is because you'll get the psychological win of being able to pay off debts in their entirety, and by doing that, you'll get the boost to be able to continue long-term and stick with it. Honestly, it doesn't matter which one you pick, both methods work incredibly well, and really at the end of the day, just pick something and stick with it. Although third, arguably the most important part of this entire video, when it comes to investing...
Okay, before we get into investing, so, wow, there's a lot of problems here. Okay, so... I don't understand how you can sit in front of a camera and say with a straight face that all that there is to debt management is which interest rate is bigger, which one is the biggest number. Like, everyone watching this video can look and see if 7% is a bigger number than 5%. Okay, that's not the whole story. It's not. First of all, the snowball method. Why is the snowball method good? Well, it's not just that it gives you a psychological victory, an early win, in that you eliminate a debt. If you have a $100 a month minimum payment on a debt, but you have enough cash flow to put another $100 a month towards that debt. So let's say you're putting $200 a month. The minimum is $100, but you're putting $200 a month towards that debt. Well, when you wipe out that debt, you've freed up $200 of cash flow, right? The $100 minimum and the $100 that you were paying extra. You're rolling a snowball through the snow. The snowball should be getting bigger. That's the idea. It's not just that you throw snowballs, the little gift they use. It's that it's getting bigger. You take the $200 a month that now is free, and you put that towards the next debt as extra payments. And then when that one's done, you take all of it, the payment from the first debt, the payment from the second debt, and the extra, and you put all of it towards the next debt. Yeah, you get an early victory, but what's really important is that if you have a financial crisis in your life, if somebody loses a job or you have major car repairs or something crazy happens, you now have a lot more cash flow. You're in a much better position to deal with life than if you're attacking the highest rate debt first and it happens to be huge. You're not actually eliminating any debt. You're not actually freeing up any cash flow by doing that. Also, if he's saying that you're missing out on tens of thousands of dollars because you're not paying these interest, you're not paying these loans down. Well, consider this. If you make extra payments on your mortgage, if you have a mortgage, it's a gigantic debt. And the debt is amortized. So even if you have a low interest rate on your mortgage, the vast majority of every scheduled payment that you make on that mortgage in year one goes to interest. It's all bank profit first, and a tiny portion actually reduces the principal on the loan. It actually builds equity for you. Unless you are making extra payments, you're basically just paying the bank every month. You're making a little progress on the loan, but it's at the absolute worst at the beginning. It's amortized. As time goes on, as you get through the years of the amortization schedule, it gets a little better. But the average length of the average length of time that someone is in their home before selling and moving to a new home in the United States is around 8 years. In year 8 of a 30-year fixed rate mortgage, you're still paying the vast majority of every payment to bank interest. That means that your equity in the home is not very large unless you're making extra payments. Okay? If you make extra payments in year one of a mortgage, just go open a mortgage calculator and do this. You will see that it will save you thousands or tens of thousands of dollars easily over the life of the loan, because you're getting rid of some of that interest by doing that. You get it knocked down as quickly as you can. That's a completely viable strategy. And it's neither snowball or avalanche. Some people only have their home as the only debt. Attack that debt. I don't care what the interest rate is. Get rid of it. Get the deed to the house so that nobody can steal your home when you lose your job, the economy collapses, etc., etc. So, yes, I mean, one of the steps in my blueprint is to undo your debts. It's called the Truth Blueprint. So it follows the TRUTH acronym. It's the middle step, undo your debts. But, you don't have to pick one of those methods. Every situation is unique. Freeing up cash flow to attack the next debt is completely reasonable. So is just paying down your mortgage because you hate having a mortgage. It's okay. But yeah, it's not, do I make more in an interest-bearing account somewhere or in the stock market somewhere with quote-unquote guaranteed returns, which they're not. That's not how that works. Okay.
Especially if you're just starting out, looking to starting up a Roth IRA. Although before we go into that, I just want to say, I find it shocking how much time people spend securing their finances, and then they make no effort whatsoever to secure their personal information and make sure it's safe. For instance, I've been traveling a lot to film guests for my podcast,
so
The Iced
this is an
Coffee
ad. Okay, we're going to skip ahead. Okay, we'll start again here.
IRA. This is an account that you can contribute up to $7,000 a year into, and then by the time you're 59 and a half, all of the profit that you make within the account is completely tax-free. Even better, but you're also able to pull out any money you contribute.
Okay, that's a weird way to say that. By the time you're 59 and a half, all of it is tax-free. That's okay, that's not really correct, but we'll go with it.
To the account at any time and without any penalty. So essentially, if you make under $161,000 a year as a single person, this is the pinnacle to building wealth as efficiently as possible. As an example of this.
Okay. So if you make under $161,000 a year and you're single, or if you make under $240,000 a year and you're married, filing jointly, this is the pinnacle of investing. But the point of this video is to tell me the blueprint that all wealthy people follow. That's not that high of an income. Like, there's people making millions of dollars a year. So, okay, let's keep going.
This is the pinnacle to building wealth as efficiently as possible. As an example of this, for the sake of simplicity, let's just assume you ignore the rest of the video and all you do is just max out your Roth IRA each and every year to the tune of $7,000. If you start doing this at the age of 20 and you retire at the age of 65 while earning an average return of 8% in the stock market, which is something that we'll cover very shortly, you're going to have $3,145,000 invested while owing absolutely nothing to the IRS.
Okay, hold on, Graham. All right, you look at the top left-hand corner of his screen share. You will see this is a compound interest calculator. Even if it was an investment calculator, most investment calculators have a huge problem too. But this is if you had a savings account and you put in $7,000 a year and you got 8% interest every single year in that savings account. This is compound interest. It's not rate of return. It's not compound annual growth rate with a known ending value and a known starting value. It's just not how stock market investing works at all. This is a very, very shaky foundation on which to make an argument. But secondly, a 20-year-old that is likely still in college paying for college, which it has astronomically increased in price over the last several decades. They're going to pay $7,000 a year every year starting at age 20 into a Roth IRA. And so note, that assumes that number one, they are never going to make above the income threshold that we saw on screen a moment ago, $161,000 a year, or $240,000 if they're married, which would disqualify them from doing this. It assumes number two, that they're going to do this every single year without fail for 45 years in a row. And then number three, it assumes that this stock market investment is going to produce a positive rate of return of 8% every single year. Now, this is a very irritating topic for me. I have a whole section of my book dedicated to this called Wall Street is Not Your Friend. And this is the argument. This is what people think is accurate. This is completely false. If you take several years of stock market returns, say 10% one year, 8% one year, negative 10% one year, 20% another year, et cetera, et cetera. You have this whole array of rates of return, and you average the rate of return for each of those years, and let's just say it gives you 8%, exactly 8%. That does not mean that your money is going to start out at $7,000 and then get an 8% rate of return. It doesn't mean that $7,000 is going to earn 8% and then you're going to put in $7,000 more, and it'll be $14,000 plus the growth times 8%. That's not what happens. The stock market goes up and down. The stock market is not compound interest. It doesn't compound. It routinely tanks in value. And it's just not how it works. It's not how any of this works. And so let's try to keep that number in mind, $3,145,000. But I mean, you're telling me that the maximum amount I could make is like $3.5 million, right? Because I have a maximum contribution amount every year. So if I follow this crazy advice, and I assume that all this is true, which it isn't, then I'm going to make, $3-4 million tops for all of that sacrifice. Okay. I don't know, man.
$45,000 invested while owing absolutely nothing to the IRS. Not to mention, the ideal time to start and contribute to one of these accounts is when you're young and not earning a lot of money, since one, you're probably already in a low tax bracket, so you have more after-tax income left over to invest with, and two, you have decades to let compound interest grow your money into something significant.
Okay, it's not compound interest. And what 20-year-old has $7,000 a year to put into a Roth IRA? Yeah, they're in a lower tax bracket because they're not making any money. So you can't say both at the same time. You can't tell me that, well, my income's really low, so I'm in a low tax bracket, so therefore I have $7,000 to invest. It's either or. I either don't qualify for a Roth IRA because I make too much money, or I make a lot of money, but still I'm slightly under the threshold, and therefore I'm not in a really low tax bracket. Like, that doesn't make any sense. It doesn't make any sense. So, also, I have to say this is another pet peeve of mine. If you say that you're in the same tax bracket, say in retirement, as you are when you're working and contributing, like if we're just making a very, very simple model here. If you say that I'm going to put in $10,000 into a tax qualified account, okay, just pretend you can put in $10,000 into a Roth IRA because the math is easier. So $10,000 into a Roth IRA, that's an after-tax account. So that means that you pay your taxes up front. Let's say it's 20%. Okay, so you have $8,000 that goes into the Roth IRA, and then that gets to earn money over a long period of time. He's saying 8% a year. That's completely ridiculous. And then at the end, there won't be any additional taxes because you paid your taxes at the beginning. But you started out with less money to grow, right? If you do a 401k or a traditional IRA or something along those lines, then you put in the full $10,000 pre-tax. It hasn't been taxed yet, which means at the end, you've got to pay your income tax when you make the withdrawals. Well, if you take that entire balance out in 1 year, then that means that it's got to hit those 20% tax deductions every time, right? So you've got to take out the tax at the end. Well, it's just a multiplication problem. If it's 8,000 time rates, if it's $8,000 times rate of return, rate of return, rate of return, rate of return, and at the end, there's no taxes because it's down here at the beginning, the 20% tax at the beginning, or if it's $10,000 times rate of return, rate of return, rate of return, rate of return, and then the 20% is at the end, it's the same number. It's the same number. One of them does not perform better than the other unless the tax rate changes. And I don't know what tax rates will be in the future, and neither do you. So you're just guessing. You might make a good guess, you might not. But it's at best 50-50. You think tax rates are going to be higher or lower when you retire? I don't know. And neither do you. So I'm just saying, it's just a multiplication problem. Go do the math right now and tell me I'm wrong.
Separate from that, though, in terms of where to open a Roth IRA, practically every brokerage offers one at this point. They take anywhere between 10 to 20 minutes to set up, and it's largely up to personal preference. And that, of course, brings me to the next part of the video that could either make or break your entire investing career, and that would be choosing your investments. Even though it's relatively simple, the truth is, very few people have the discipline to actually follow it without getting caught up in the premise of get rich quick. So if you want the blueprint to building wealth long term, for most people, this is how you're going to do it. First, diversify.
So again, why is it for most people you should do this? Why? Like, I don't act like my clients are dumb. I don't give them different advice from what I would do. I tell them exactly what I'm doing and why I'm doing it, and they can choose to follow that or not. But I don't give people the dumb person advice. It's so weird to me. It's really, really off-putting.
This means that you should never invest all of your money into one stock, into one cryptocurrency, into one place, because if you do, there's a chance that you could lose a significant amount of money. For example, tech stocks lost 78% during the dot-com bubble. Housing prices declined more than 50 to 70% depending on the area, and cryptocurrency fell as much as 99% depending on the project. Point being, you have to spread out your money throughout different companies, asset classes, and sectors, so that if something happens to one of them, you have something else to fall back on. Second, don't try to beat the market. Even though it's tempting to want to utilize alternative investments, pick your own stocks, and try to get higher returns in your portfolio, the reality is almost everybody fails. Like, even the best hedge funds and investors can't beat the market consistently with every resource at their disposal. So unless you work for Congress, I wouldn't even try. Instead, you should try to ride the market in its entirety. And sometimes the most simple approach is also the most effective. Like, third, stick with index funds. A few years ago, Warren Buffett famously said that this is the single best investment for the vast majority of people. And I don't think he's wrong. Index funds offer a wide variety of stocks and industries, they're incredibly diversified, and best of all, they're very cheap to own. For example, Fidelity offers no-fee index funds that cover just about anything that you'd want to buy. And this is also how I'm investing my own money. Even though it sounds boring,
Okay, there's always some kind of expense structure somewhere. Okay, there's always some kind of expenses. Yes, there are higher and lower expenses, but you don't just get a free account and then invest in funds that are free and then get all the returns for free. Like, there's different types of shares of different things. Okay, there's A shares and B shares, etc. There's lots and lots and lots and lots of different complicated things in the stock market, and they work differently. I don't know anything about those specific funds, but Fidelity isn't giving you completely free access to particular investments. That's not offered. That's not a thing. Okay, but index funds generally do have lower fees than other things because it's not being actively managed by anyone, right? There's a level of you're just going to take what comes from this investment decision that you're making. It's absolutely true that almost all mutual fund managers, hedge fund managers do not consistently beat the market. What is true is that if you're putting your money into those types of things, they're taking their fees, whatever the fee structure is, the fees are still there. And so, however the fund does, you're earning less than that because they get paid when the market is up and when the market is down, period. That has profound impact on your investing over time. And, this may be a good time to say there's lots of other things you could invest in that aren't stocks. Lots and lots and lots of things that are not stocks. It might be a better use of your time and resources to learn about some of those things and pursue some of those things. Who cares if you beat the market if you have a business that produces a great income? Or 5 businesses that you have managers for that all produce some income. I don't know. This just seems so surface level to me. Diversify, again, like if you're all in on one thing and it does well, man, you did really, really well. It's possible. It's also possible to go all in on something and have a huge loss, but that's still true with mutual funds, ETFs, index funds, all of those things. They have bad days, bad decades even. It's it's weird. It's weird to say that this is the blueprint.
Most of my stock market portfolio is comprised of just 2 funds, 80% S&P 500 and 20% international. That's it. It's nothing fancy, but it's stable for what it is, and it covers the entire world. And finally, fourth,
what does that mean, stable for what it is?
Assuming you do the above, just dollar cost average and do nothing for a very long time. Unfortunately, I would venture to say that for most people, this is the most difficult part to follow, because even if you get everything else right, if you panic sell at the bottom and you don't keep buying when the market drops, you could potentially miss out on some record profits when the market eventually does recover, and that could set you back a lot. Like, just imagine you panic sold in March of 2020 because you believed the market would fall further and you could buy it back cheaper. You would still be waiting. Or imagine you sold at the peak because stocks are really expensive, and then the market just kept going higher. The fact is, practically every study out there has shown that a buy and hold approach over a well-diversified portfolio long-term wins in the vast majority of situations. Although, in terms of how much you could expect to earn from something like this, here's where things take a bit of a turn.
Okay, before we get into all that, you have to understand that tax qualified plans, auto enrolling into your employer's 401k or Roth 401k or whatever it is that they offer, the automatic assumption that you should invest money, a percentage of your income, every paycheck, every time for the entire time that you work, your entire working life, that props up the stock market. You're driving up stock prices. It's this kind of wishful thinking that if we just keep throwing money at it and keep throwing money at it, it's only going to go up. And the wealthy, the really wealthy people that are very, very honed in on when to buy and when to sell, and they're making huge moves like planting $5 billion in a particular stock all at once. Those people are waiting for the right moment. You know what I'm saying? We're talking about the best way to get rich. We're talking about wealth. We're talking about large estates here. And this is just not that. This is propping up and enabling some of the behavior of some of those multi-million and multi-billionaires. Stock prices are going to just keep getting more infusions of cash every single payday because millions of people don't look at what's going on. You're not investing, you're spectating. That's an Andy Tanner quote. But you're not participating. in your investment activity that's just watching to see what happens. It's not doing anything. All you do is sign up and say, sure, that sounds like a decent mix of mutual funds from the 11 choices that you gave me, 3 of which are bond funds that have like a 4% annual return. That's nothing. It's nothing. Okay. And so this is extremely surface level and extremely generic. This is the same advice you would get from basically any financial services office anywhere in the country.
Much you could expect to earn from something like this, here's where things take a bit of a turn. Over the last 100 years, the S&P 500 has averaged an annual return of 10.6% with dividends reinvested, and over the last 14 years, that amount is 13.4%. Although the bad news is that doesn't mean you're guaranteed to see those same type of returns in the future. Unfortunately, your overall average return really just depends on 2 things. 1, when you start investing, and 2, how long you invest. For example, the S&P 500 averaged a negative 5.2% return from March of 2000 through March of 2009, which coincided with the peak of the dot-com bubble and the bottom of the Great Recession. But if you started investing in 1978 and continued until the year 2000, you would have seen a 17.4% average return. This suggests that even though we could look back historically and see that 20-year rolling returns have always been positive, annual returns could range anywhere from 2% in the worst case to 18% in the best case. And it's completely possible that future 20-year returns could look entirely different. All of this brings me to a really interesting study that asks the question, with stocks trading at the levels they currently are, what would it take for us to see a repeat of the last decade's performance? Or basically, how likely are we to see another decade of 12.8% annualized returns?
I mean, there's no way to know that, but okay.
That so many people have grown accustomed to. Well, to answer this, the author makes the point that these last 10 years have been exceptionally good for investors, coming in well above the 90th percentile of rolling 10-year performance since January of 1950. He summarized that much of this has to do with the fact that the Federal Reserve has kept interest rates at such low levels that it forced investors to place their money into the markets if they wanted any meaningful return.
You see, that's a huge problem. Do you understand how big of a problem that is? Interest rates being super, super low. The Federal Reserve manipulates interest rates. That's what they do. And yes, it influences behavior, especially of large investors. And so just funneling all this money into the casino.
Whatsoever. This also coincided with strong earnings growth, which led to record stock market profits. However, now that interest rates are hovering near their highest level in decades, this author makes the argument that the price-to-earnings ratio would have to double from its current value in order for the stock market to post a repeat performance, nearly 40% higher than the tech bubble peak. Although, of course, there's also earnings growth to consider, because over the last 30 years, companies have benefited from declining interest rates and lower taxes. But to have another decade of record performance would have to include 6% real earnings growth, which is roughly the best ever outcome over a 10-year period during normal non-recessionary times. Or I guess simply put, don't expect that these types of returns will continue indefinitely. That's why in terms of what we could realistically see, Vanguard went on record to say that they've downgraded our US equity return expectations to an annualized 4.2 to 6.2% over the next 10 years. Charles Schwab also tends to agree with this, having updated their prediction that US large company stocks will increase by an annualized rate of just 6.2% over the following decade.
Okay, so what you're telling me is just go put my money in a high yield savings account, right? I mean, that doesn't sound like I should go open a Roth IRA to me. Now, I'm not saying I agree with these articles or have read these articles or anything, but that's a very strange way to sell me on a Roth IRA, don't you think?
I say all of this just to set the expectation that earning 12 to 15% a year in the stock market is not normal. It's very difficult to sustain, and it's not something that you should keep in mind if you want to invest long term. Instead, we should set the expectation that long-term averages are something to consider, and over the next 20 to 40 years, it's looking more and more likely that we could see the average 7 to 8% returns, which have been more consistent throughout history. Although in terms of how I'm investing my own money, given everything we've just discussed, here's my entire strategy, and hopefully you find this type of transparency helpful. So here's my entire portfolio breakdown.
All
As you're
right.
about to see,
Okay.
I've taken the approach of stability and diversity because honestly, I really dislike losing money. I don't know, for whatever reason, it just stresses me out when I see my investments decline in value, even if it's short term. I also tend to price in the worst case scenario possible and then back model based on that. So everything is really optimized for safety and consistency. I guess in part, this is kind of why 35% of my portfolio is held in residential real estate. These consist
35% of his portfolio is in real estate. Where did he tell you to put your money in real estate? Now, I might have said this earlier in the video, I don't remember, but the vast majority of millionaires in the United States became millionaires through real estate investing. But if that's the case, and this is how to invest in 2024, the best way to get rich, why isn't he talking about real estate for you? He's just telling you that he's doing that, but not that you should.
to properties that I purchased between 2011 and 2020 throughout Southern California, and most of them were fixer-uppers that I renovated and later rented out for a profit. All of them have long-term tenants, all have mortgages that are fixed for 30 years between an interest rate of 2.8 to 3.3%, and overall it's been incredibly stable. On top of that,
Okay, so he's got mortgages on all of them. So what happens if something happens to his income? He's going to have a huge handful of mortgages that are all going to come due. He's not going to be able to make his payments. I don't know, man. Is that a good idea?
values of these properties have gone up significantly. I have no difficulty renting a vacancy usually within about a week, and the repairs have been somewhat minimal for what it is. The second, another 35% is held throughout index funds.
Okay, so, and again, we're at 70% of his total portfolio. That's a lot of money to not have direct access to have direct control over. His real estate, I mean, if the real estate market were to crash, which depending on who you are, you might think that's more likely or less likely, but if real estate markets to crash and he needed to get rid of some of those properties to make up for some of his downfall in other areas, prices are going to crash, right? He's got a low interest rate. So following his own logic from earlier in the video, he thinks that he can make long-term 5.25% in high yield savings accounts. And by doing that, he's outperforming the interest rate on his mortgages, so he's not paying down the mortgages. That is a whole lot of mortgage acceleration letters to receive all at once if he can't make payments. It's a massive, massive risk. I don't like index funds. I don't like investing in the stock market. I used to do that. I don't anymore. That's probably a separate video. But anyway, that's a lot of maybes in this portfolio.
Like I mentioned earlier, practically all of my portfolio is simply two funds, 80% S&P 500 and 20% international stocks, and that's really it. All I do is buy and hold on a regular basis, regardless of where the price is. I don't intend on touching this money for another 20 to 30 years, and honestly, it's just a really set it and forget it approach. A third, like I mentioned earlier, another 20% of my portfolio is held throughout treasuries, high yield savings accounts, and money market funds that are earning about 5.2 to 5.3%. Even though in hindsight, this should have been invested in the markets because the markets have done incredibly well, I like having cash on hand to cover business operating expenses, overhead, living expenses, real estate renovations, repairs, or anything else that just might come up. Plus, earning 5.2% on my money is still pretty good. And finally, fourth,
that's ridiculous. Oh, I should have just put it in the stock market. He just said that he doesn't like losing money even short term. I can't take this seriously. Okay, let's keep going.
The remaining 10% is comprised mostly of alternative investments, a small amount of Bitcoin, and other assets that are really going in the bucket of, if they go up in value, that's great. And if they decline or are worth nothing whatsoever, that's totally fine too. This is really just the fun category, like the Ford GT, where there's really no expectation whatsoever. So really, as you can see, I've done my best to invest my money equally throughout as many uncorrelated assets and investments as possible, so that if something happens with one of them, the other should more than make up for it. And if something happens to all of them, I still have cash on hand to be able to buy the dip. That's why if you want to build massive wealth,
No. Okay. So no, no, no. Let's go back to the pie chart if I can catch it. Okay. 2008. It wasn't that long ago, really. Okay. Utter collapse. The floor fell out from under the housing market. Banks were shutting down. Massive, systemically important, as they would say, sci-fi's, systemically important banks. Okay. Those were shutting down. People had no access to their cash that was in the bank, right? They don't actually have the money in the bank. The bank is holding that money, sort of. They're really just lending it out and making more money. But if they don't want to give it to you because they can't, they're not gonna. Again, infinite banking, life insurance companies. Life insurance companies are 100% reserved. The money's all there. If you ask for the money, they're contractually obligated to give it to you, period. They can't declare a bank holiday. So anyway, he's 35% of his portfolio, 35% real estate. He's got mortgages on every single property. That is a huge risk. Index funds, 2008. What happened to the S&P 500? What happened to tech stocks? What happened to all those things? They all plummeted at the same time that real estate values were plummeting, and people were losing their jobs. You lose your jobs, can't make the mortgage payments, you can't find a renter because they can't afford to pay rent because they don't have a job. Your stock market portfolio is crashing. Your treasury yields are down. What are you going to do? What are you going to do? You're going to sell that Ford GT is what you're going to do. That's not good. That's not good. There's virtually no safe money in there. Yeah, you've got some high yield savings. He didn't say how much is treasuries versus high yield savings. Yeah, he's got some money in high yield savings accounts, but it's in a bank account. And if banks are shutting down, like if we have a collapse, if we have a bad situation, he's in really, really bad shape. It's not just that he's not going to have any money, it's that he's going to be in a real estate collapse scenario way, way in the hole. It's going to be underwater. I'd be paying down those mortgages, my friend. Okay.
or are worth nothing whatsoever, that's totally fine too. This is really just the fun category, like the Ford GT, where there's really no expectation whatsoever. So really, as you can see, I've done my best to invest my money equally throughout as many uncorrelated assets and investments as possible, so that if something happens with one of them, the other should more than make up for it. And if something happens to all of them, I still have cash on hand to be able to buy the dip. That's why if you want to build massive wealth long term, a lot of it really just comes down to the basics, and that is optimizing your income and expenses, paying down high interest rate debt, maximizing your tax-advantaged retirement accounts, diversifying, and then staying consistent long term. I know it's not as exciting as the idea of being able to make $100,000 a month from dropshipping anywhere in the world from your computer, but it's the truth. And if you could follow this consistently, you're going to be able to build a really strong financial foundation long term. On top of that, all of these strategies are really meant to be as timeless as possible, so that you could save this video and come back to it a year from now, or even a decade from now. And all of the strategies are going to be just as applicable in the future as they are today. Just like hitting a like button.
No, okay, we're done with that. So I can't believe this guy. I mean, I can't believe this guy. First of all, he really doesn't like drop shippers, does he? That's interesting. There's nothing wrong with drop shipping. I guess that's what he thinks of people who build their own business that isn't YouTube. So he's got a huge YouTube income. I know he's got lots of subscribers on YouTube. I don't want to give the number because it'll be different tomorrow. But he's got a huge following on YouTube. He's got a lot of YouTube income. That's his like job. And then of course he's got his real estate and all that. But he's getting large paychecks from YouTube. Assuming that'll always continue, by giving this type of advice, he probably doesn't qualify, almost certainly doesn't qualify to do a Roth IRA himself. So he's giving you the, well, you're not very good with money and you're probably kind of poor advice that isn't what wealthy people do. It is not the blueprint that wealthy people follow, period. That's a completely ridiculous premise for that video. So a little frustrating. You know what wealthy people do? They have gigantic amounts of life insurance. They have gigantic amounts of life insurance. They can take policy loans. They can take advantage of strategic investment opportunities, guaranteed. They don't have to ask permission. The life insurance company will give them the loan because they have the cash value. It's not that the insurance company controls the asset. The individual owner controls the asset, period. And so, if you take a loan out of a Roth IRA to take advantage of some kind of cool real estate deal somewhere, that's great. Except that you've completely compromised the growth of that account. I'm not even saying that the growth is all that great. It's certainly not what it's cracked up to be in that calculator that Graham used. But if you think that your growth in a Roth IRA or a traditional IRA or whatever is going to be spectacularly good, but you're going to take a loan out of it to go do something else, you're crazy. You can't have both because the money doesn't perform in both places at the same time. A life insurance company, a life insurance asset properly devised, properly structured to do infinite banking does work that way. You get the growth in the policy and you get to take advantage of investment opportunities using policy loans at the same time and get the benefit of both. It doesn't interrupt the compounding, the true uninterrupted compounding of your life insurance policy. I hope you found this video helpful. If you want to see me tackle some of the popular financial lies and half-truths that are out there being spouted every day in videos like this one, check out my book, Between the Lies, How to Reclaim Your Future from the Banks and Wall Street. It's available on Amazon in print, digital, and audiobook format, narrated by me. It's a bestseller, and I'm quite proud of it. If you like this video, you'll find another one coming up on screen here in just a moment. Please check that one out as well. Don't forget to subscribe to the channel. We'll see you in the next one. Thanks so much for watching.
Thank you.